Welcome to Trader Chat. Today is the 29th of February, a very special day, the 29th of February in a leap year, of course, and this is our 21st Trader Chat. As always, I need to start things off by going through our very important and legally obliged disclaimers. The first disclaimer tells us that all trading involves risk. Please be aware of and accept this risk before trading, and never trade with money you cannot afford to lose. The next disclaimer is a past performance disclaimer, which tells us that past performance of any trading methodology is no guarantee of future results. I'm also making no representation in this webinar that any account will achieve profits or losses similar to those discussed. And finally, you should be aware that all results should be considered to be hypothetical unless otherwise specified, and hypothetical performance results have many inherent limitations and, unlike an actual performance record, do not represent actual trading. A few quick words about using NetViewer. I know we have many old hands with us today, but there are a few new names. So you should be aware that the best way to ask questions is to type a message into the chat window. If you cannot hear me, you need to open the VoIP tray in your NetViewer control panel, which is on the right-hand side of your screen usually. I believe you can move it over to the left. And you should slide the speaker slider up. I don't know why I say this every week, because of course if you can't hear me then you wouldn't hear it, but anyway, there it is. If you would like to speak to me, not that I don't think anybody has for quite a long time, but if you would like to speak to me and you have a headset, then right click to indicate that and enter a chat message, because there are many accidental right clicks. Speaking of which, please be careful of mouse clicks, because a left click pops up a brightly colored arrow and a right click pops up a speech bubble, both of which are quite distracting if they happen accidentally. So please be careful of clicking in the NetViewer window. A quick reminder that, of course, we do Trader Chats every 2 weeks, and every other week we do Hurst Signal Chats, which we call Signal Chat, very creatively. And so today is, of course, a Trader Chat. Our Trader Chats are slightly more advanced, if you like, more in-depth discussion about the use of sentient trader software and discussion of cycles and Hurst cyclic principles in general. But even if you are a user of sentient trader software, you might very well be interested in our Hurst Signals service, which provides trading signals and analysis down to the 5-minute bar detail, from 40-day cycles all the way down to 5-hour cycles on a whole lot of different instruments. We are launching some new instruments next week. We have some commodities on the way, and the FTSE 100 in the UK, and we're looking at the DAX, so a whole lot of new instruments are coming to Hurst Signals in the next week or so, and so go along to hurstsignals.com if you are not familiar with our Hurst Signals. Take a look, and also look out, if you are a reader of the Technical Analysis of Stocks and Commodities magazine, look out for a review of Hurst Signals in the April edition. The April edition is their Cycles edition, and they are going to be reviewing Hurst Signals. So look out for that in the April edition of Technical Analysis of Stocks and Commodities. Today, I thought we would take a long-term look at the Dow Jones Industrial Average. I was inspired by a forum post by Silent One, one of our sentient trader users, who pointed out similarities between the market in 1974 and the market today. And he wrote a really fascinating post, so take a look at that. It's on our Sentient Trader forum. And a really interesting post. Another one today about the long-term picture for the euro-US dollar. Also a really interesting take on the euro-US dollar, comparing it to the United States dollar against the Japanese yen. So that's well worth taking a look at. So go along to our forum and take a look at those. Let's have a look at the Dow Jones Industrial Average. Today's webinar is going to be a bit it's going to be a bit like what I call a sort of a fireside chat. It's going to be me looking at charts and talking. Hopefully I'm going to make sense. I'm going to explore various sort of alternative analyses in terms of what's happening in a really long-term picture. And as always, I welcome your comments and any thoughts that you have. The more interactive we can make today's Trader Chat, the better, because I'm not sort of presenting hard facts necessarily. I'm presenting quite a lot of opinion and possible ideas. So let's take a look at the Dow Jones Industrial Average. The reason I've chosen the DJI as opposed to S&P 500, which is what we usually speak about, if I can say we usually speak about anything at all. The reason I've chosen the DJI is because you can get data going all the way back to 1928 from Yahoo. In fact, some Sentient Trader users I know have performed analyses on data going back to 1918. And one very brave Sentient Trader user has performed an analysis going back on data all the way to 1878. And I've seen the results of that analysis, and that's been really interesting. But for today's discussion, I'm going to talk about the Dow Jones Industrial Average going all the way back to 1928. In fact, of course, the first prominent trough in the analysis that we're going to be discussing is the trough in 1932. After the 1929 to 1932 crash. So here is what I call the default analysis. Whenever I perform an analysis with on any instrument in Sentient Trader, the first thing that I do is I select an analysis period, of course, in terms of defining when the analysis should start. So I did that here. It was a very obvious decision just before the trough in 1932. And I then simply click on the Analyze button, and I let Sentient Trader do its thing. I don't try and influence it at all. I just see what the software will do and what it will say. Having done that, I usually maintain that analysis because I've found very often Sentient Trader has proved me wrong. I'll be absolutely convinced that Sentient Trader is wrong, and I'll be forcing Sentient Trader to bend to my will and to change its analysis in the way that I think things are really playing out. Only to find after some time has passed that in fact Sentient Trader was right all along. So I always maintain what I call a default analysis, and this is that default analysis. First of all, obviously, I'm using logarithmic scaling, which you can do in Sentient Trader. Simply with the click of this button over here, you can switch between linear and logarithmic scaling. That's the linear scale of the Dow Jones Industrial Average. Over a very long time period, linear scaling gives one a very poor idea of what's really happened in the market, because it looks as if though, way back in the 1950s and before that, it looks as if though the markets never moved at all if you use linear scaling, generally because, of course, markets are much higher now than they were back in those days. So you switch to logarithmic scaling when you're looking at long-term charts. I find when you're looking at short-term charts, it makes very little difference at all. But seeing as we're considering a long-term picture today, we're having a look at the logarithmic chart. On a logarithmic chart, an equal distance on the chart represents an equal percentage fall. So there are a few things that I can point out straight away, and that is that if we measure the percentage fall from the peak in 2007 down to the trough in 2009, that's a vertical distance on the chart of about it looks like about an inch on my computer screen. Okay. And if we have a look at the fall from 1929 to 1932, that's from this level here all the way to the very bottom of the chart. So that's about looks about double the extent of the fall. So using a logarithmic chart, you can compare price falls and price rises simply by comparing them on your chart. Okay, and the fall in the 1970s down to the trough in 1974. In 1974 looks like a slightly lesser fall than the one that we experienced in 2009. So those are a few sort of obvious things that we can see straight off the bat. So what's the default analysis saying? Well, the nominal model that I'm using on this analysis, by the way, is Hurst's nominal model, which means the longest cycle in the nominal model is 18 years in length, and that is this red cycle, which you can see over here. So let's point out the 18-year cycle troughs according to this analysis. The first one occurred in 1932, of course. The next one occurred in 1949 over there. That was just over 17 years later. The next one occurred in 1962, okay, over there, and then the next one occurred in 1982, I believe that is, over there, and then finally is that correct? And then finally the last one occurred in 2009 according to this analysis, okay. Making that last cycle really very long, okay, much longer than any of the previous ones. As you can see from the semicircles at the bottom of the chart, the semicircles have different heights because they are drawn as semicircles, so they have different heights which reflect the length of the cycles. Hurst's principle of variation specifies that, of course, cycles can vary tremendously. Okay, so that's the longest cycle that has been phased. There is some debate as to whether the next longer cycle in the nominal model should be a 36-year cycle, which would have a harmonic ratio of 2:1 to the 18-year cycle, or whether it should in fact be a 54-year cycle, which would have a 3:1 harmonic ratio. If it is the former, in other words, a 36-year cycle, then according to this analysis, the 36-year cycle troughs would have occurred over here in 1932, then again in 1962, I think that is, and then here in 2009. Okay, so if we believe there's a 36-year cycle in the nominal model, then of course this analysis is telling us that that 36-year cycle trough occurred in 2009. Personally, I think this is very questionable. I'm just showing you the story, and then I'm going to show you how I'm going to try to get Sentient Trader to bend to my will and change the analysis. But certainly this is a possible scenario, all right? This is something that might be playing out. There are various reasons why I don't think it is playing out, as I'm going to elucidate as we continue. But anyway, that's if we believe that there is a 2:1 harmonic ratio between the 18-year cycle and the 36-year cycle. If the next longer cycle after the 18-year cycle follows the same pattern as the nominal model on the monthly basis, you will know that there is an 18-month cycle, and the next longer cycle is considered to be the 54-month cycle, harmonic ratio of 3:1. It's possible, and it would be beautifully symmetrical, if you like, if the same thing happened on a yearly basis, in which case there is an 18-year cycle, and then the next longer cycle would be a 54-year cycle. That would mean that this trough in 1962 is not a very important trough of the 36-year cycle, but in fact this trough in 1982, according to this analysis, is a trough of the 54-year cycle, and this trough in 2009 is simply a trough of the 18-year cycle and not a trough of the 54-year cycle. And now, just as a matter of interest, I'm not really willing to commit either way as to whether there is an 18-year cycle, a 36-year cycle, or a 54-year cycle. Although personally, I tend to lean towards the fact that there would be a 54-year cycle next up in the nominal model instead of a 36-year cycle. But I'm perfectly open to debate about the subject. But the reason why